Okay, so when we now look at topic number 10, standard costing and variances. Of course, the standard cost card, we know how to prepare it. We did that yesterday, and even reached at the point whereby we are preparing the variances. Now, if you look at what was tested there in December 2022, question number 4, A and B. So December 2022, question number 4, A and B, but my interest is question number B. So if you look at question number A, of course, that one you should be able to answer. The arguments in favor of marginal costing. You know very well that marginal costing says that fixed production overheads do not form part of the product cost, and therefore this fixed production overhead is expensed. It is expensed in the income statement. Then that is marginal absorption costing. And then if it is expensed, it does not come or become part of the product cost, and therefore the product cost is reduced. The cost of inventory is reduced, is understated. When I go to absorption, you can recall you are taking now this to be part of the product cost, and therefore it increases cost of inventory. The fixed production overhead is taken to be part of the cost of inventory. So you don't expense it in the income statement. Instead, we again take it to be part of the assets of the company. Don't you see that is a challenge? So when they ask you to do what? To give the arguments in favor of marginal costing, then now this disadvantage of making the fixed production overhead to be part of the cost of inventory has been solved by the marginal costing, which takes it to be which expense. It is already incurred. You've already incurred that. So you don't need again to call it as an asset, yet you've already incurred the fixed production overhead. So you must take it to the income statement and charge it in the real or in that particular financial year. This one disobeys that. So those are some of that's an advantage of marginal costing. Another thing, you will also compare which one are we going to use to give the management a real status of their operation. That cost has already been incurred, so we are not going to include it as part of the product cost. Then it now tells us that it does not exaggerate the product cost. As we've seen in practical application in topic number 7. So many of them are there. I've shared with you the notes. Those are some of the theories that you need to put in place. Then we get to our question number 4B now. Quota Limited manufactures and sells a single product branded TT with a standard cost of shillings 1,100, made up as follows. So I want you to be very keen. I want you to see the trend of these people. If you look at whatever we did yesterday, the April sitting 2023, they introduced 2 items. That is the sales volume and contribution variance. The other things have always been tested. They only added 2 things. So they are trying to test for everything within the variances. If you now get to this December sitting, you'll be able to see the same items that you were having in yesterday's question. They are going to be there, but now they have eliminated the first 2. The sales and contribution is now missing, but now they have included what we call the fixed overhead capacity variance and fixed overhead efficiency variance. That's the only thing they are adding. The other 2 has been there. Same formula that we used yesterday will be applied to solve the same. So as you can see, every sitting you already have 8 marks before doing anything. Every sitting you'll always have 8 marks before doing anything, including the August sitting of 2023. So let's see. We are given material price variance and material usage variance. That's what we need to get. Labor variance, that's labor rate and labor efficiency variance. We are given the standard cost card. So in the next question, or even in August, or in your sitting, this is what they are going to do. They are going to tell you to come up with a standard cost card. So the standard cost card is the first thing that is given to us there. As you can see, we have direct material, we have direct labor, we have variable overheads, we have fixed overhead. And I want you to be very keen. Direct material, we are given 15 square. We are given 16 square meters. We are given 15 square meters at shillings 30. But for you to produce a complete product, TT, you are required to spend shillings 450. So it means how many units of this raw material do we need to produce the finished product of TT? How many units? For every 15 meters, you're going to spend 30 bob. We've spent 450. We've spent 450. So are we able to get, if 15 meters is equal to 30, 450 shillings itatupatia ngapi? So that is 450 multiplied by 15 meters square, then we divide by 30. I have this, I'm going to have 5 here. So 45 by 5, what am I going to have? 45 by 5. Is it 135? Is it 135? Is it 135? 45 by 5. Okay, by 2 is 90, by 4 is 180. Good, 225 squared meters. That is the raw material that we need to produce one finished product of TT. But this number of meters, the cost per meter is 30 shillings. The cost per meter is 30. I mean, the cost for every 15 meters is 30 shillings. So we can get the cost per meter. If you're going to be given the variances, then you are required to work it backwards to get your cost per unit. Here you'll be given variances, then you are required to work it backwards up to this point. Whatever you're going to do or you're going to get when you use the variances will be this. Whatever you're going to get when you use variances will be this. So it is this one here that you are now going to convert again to get the shillings into 450 and also get your 15 meters square. We are going to see that in August sitting. August of 2022, you are going to be able to see the standard cost card that we are talking about. So let's now come to this part. Material price variance is equivalent to, we are comparing the variances in the prices. So we get the standard price minus actual price, then everything we multiply by actual quantity. Material usage variance will be equivalent to standard quantity minus actual quantity. Standard quantity in actual, standard quantity in actual production. Don't forget that. Then actual quantity multiplied by the standard price. Actual price, as you can see, actual price is only used when we are comparing prices. Any other thing, you are going to use standard price. Then labor rate variance will be equivalent to standard rate minus actual rate. Then everything we multiply by actual hours. Labor efficiency variance will be equivalent to standard hours of actual production. It is standard hours but of actual production with less actual hours. Then everything there we multiply by the standard rate. Then everything there we multiply by the standard Everything there we multiply by the standard rate. Good. So that's what you need to know. So let's work out these ones first because you are familiar with these ones, and then we now get to the new items that you are going to introduce. So I want you to help me get that material price variance. Material price variance, the formula says material price variance. Material price variance will be equivalent to standard price minus actual price. Then we multiply by actual quantity. So what are we going to have? The standard price. Somebody to give us the standard price. Somebody to give us the standard price. Tutakuwa na ngapi? Standard price tutakuwa na ngapi? Standard price. So let me see the question. We are given direct materials 15 square meters at shillings per square meter. It is 30 shillings per square meter. So what is the standard price of the raw material? And whatever we have there is the standard cost. Cut. Below it, we have what we call actual figures for the month of November. Is also given as follows. So mtu anatupatia 1300. I believe you are seeing what we are actually having. Good. So I've seen where the problem is. Let us differentiate these two things. We have direct material and we have finished product. These people do not produce the finished, they do not produce direct material. No, they have the raw material and that's what they use to produce which product? TT. So the finished product here is what we have as the TT. This is the product they are going to produce by use of what? By use of raw material. The variance here we are looking for is material price variance, not finished product price variance. No. It is the material price variance. If you read that statement very well, the standard selling price per unit is this, and then we have the monthly budgeted projects, production and sales of 1,000 units. That is what we have. Actual production is 1,400 units. So the raw material that we are going to have there, the selling price of the raw material is 30 shillings. That's the standard minus actual price. When we now went to the market to buy the raw material, how much did we spend? How much did we spend? When we went to the market now to buy the raw material, actual figures. Direct material, we purchased 22,000 square meters at shillings per square meter. At shillings per square meter. So what did we spend for the square meter? The actual amount was 40. But actual quantity we are given there as 22,000 square meters. From this point, I budgeted to spend 30 per unit of raw material. I ended up spending 40. So it means automatically this one I know is adverse. But then, can I get the actual figure now? 30 minus 40 multiplied by 22,220. I've known very well it is adverse or negative. So that is it. Then I should now move down to calculate material usage variance. Material usage variance is equivalent to, now we are comparing the variance of quantity. We don't use the price, we use the quantity. But the price variance is now the amount you are going to spend to buy these goods. So here, material usage variance, the quantity that we budgeted to use, we said it is material usage variance is standard quantity in actual production minus actual quantity, then you multiply by the standard price. Now, are we able to get the standard quantity in actual production? They anticipated that for every finished product TT, or for every unit of the finished product TT, they are going to require how many units of raw material? They are going to require how many units of raw material? We were told that 15 square meters of this material, which they are going to buy at 30 shillings, to give them 450 shillings, is what they are going to use to do what? To produce one finished. Just look at the opening statement there. The standard cost card of producing a single product TT is 1,100 and distributed as follows. The 1,100 has got direct material, which is 450, has got direct labor, has got variable production overhead, has got fixed production overhead. The direct material, you are able to see we have 450 shillings. A unit of that raw material is going for 30 shillings. So are we able to get the actual quantity per unit of the finished product? Is 450 divided by 30 to give us 15. But we are able to see that 15 is already given to us, 15 square meters. Now, the 15 square meters, that is the standard quantity per unit of the finished product in actual production. The actual production is now the budgeted units of the finished product. Sorry, the actual units of the finished product. Under actual results, under actual outcome, how many units of this product did they manage to produce? How many units of the finished product did they manage to produce? That is what we now need to understand. So are we able to get that? Are we able to get that? Sales 1200 units. Actual production tumepewa ngapi? Actual production we are given 1400. So it is actual or standard quantity in actual production, then minus, so this one is what we have here, this portion, minus actual quantity of the raw material that was used. The actual quantity, I think we used it up here. This is it. So I less 22,000. Then I will do what? I will multiply this by the standard price, which is already provided up there. Now, I just want you to give me this figure, then I will tell you whether it is favorable or adverse. 15 by 1400, tunakuwa na ngapi? 15 by 1400. 15 by 1400, 21,000. I anticipated to produce 1,400 units. I anticipated to produce 1,400 units of TT by use of 21,000 units of this raw material. But I ended up spending 22,000 units of the same raw material to produce the same unit, because actual production is 1,400. Here, I anticipated to spend, I budgeted 21. I'm ended spending what? I've ended up spending 22,000. So I've gone above the budget, and this is an expense. So I cannot celebrate over this. I must just ask myself, what happened in the process? What happened in the process? So I need to take care of that. And if it is beyond my budget, of course, it's going to be adverse. I never anticipated that. If it is adverse, 21,000 minus 22,000. 21,000 minus 22,000 tunakuwa na ngapi? You're going to have 1,000. 1,000 by 30 tunapata ngapi hapa? And I know very well it is adverse. It is adverse. Sorry for that. So this is what we have. This is what we have under material. As you can see, there is nothing that is changing. Everything will be provided. It's just as simple as such. So we are now through with these two items. We are now supposed to move to this part. So the labor rate variance. So the labor rate variance is equivalent to Labor rate variance is equivalent to standard rate. So the labor that is given there, direct labor, we are supposed to spend 5 hours to produce 1 unit of tea at shillings, at 20 shillings per hour. So the labor rate per hour, is as per the standard, so the standard rate minus actual rate, then multiply by actual hours. The standard given there is 20 less actual rate. Actual rate tumepewa ngapi? Actual rate tumepewa ngapi? The direct labor, actual rate tumepewa ngapi? Why not 100? Let me see. Good. Why not 100? 5 hours. We need 5 hours of labor to produce 1 unit of TT. But 1 hour for the labor, they are going to charge us, is it 20 shillings? They are going to charge us 20 shillings. 1 hour is equivalent to 20 shillings. But for us to produce a complete unit of TT, we need 5 hours. We need 5 hours. So it means the amount we are going to spend to produce 1 unit of TT is equivalent to how many shillings? 100 shillings. 100 shillings. So what is the labor rate? If somebody asks you the labor rate, will it be 100 for the 5 hours or 20 shillings per hour? That is who is this? Faisal or who? Yes. Is it going to be 100 to produce 1 unit of TT, or it's going to be 20 shillings per hour? What are we going to have? You're explaining variance overheads instead of labor. What are we going to have? The direct labor hours is 5 hours. At what rate? Okay, something is missing. Something is missing here. Thank you for that. The 5 hours of labor are required to produce 1 unit of tea. But 1 hour, we are going to be charged shillings. 1 hour, the direct labor is 5 hours at what rate per hour? At 100 shillings per hour. Thank you for that. Sorry. It is 100. And that's why if you look at it very well, you'll be able to see that the standard cost card is going to indicate 500. We need 5 hours to produce 1 product of tea. But 1 hour, we are going to be charged 100. And therefore, the total amount you are going to pay to produce a finished unit of tea is 500 as per the standard. So the labor rate per hour, 1 hour is equal to this. That is what we are looking for. Which is this? Which is this 100? Which is this 100? Which is that 100. So we want to look at the actual rate. Actual rate utakuwa na ngapi? The actual rate, if I look at it very well, the actual rate, we have paid for direct wages, we have 6,800 hours. That is the actual. That is the actual. But then, have we been given the rate? At shillings per hour. We are given 110 per hour. In some questions, it is going to be the same thing, but the only thing they do, they don't give you this 110. No. They know very well you'll be able to calculate with that 110. So they take 110, multiply by this, and give you the total figure. So it is upon you to know how to get the 110, which we should have here. Then we do what? Then we get actual hours is already given there as 6,800. I anticipated to pay for the labor at 100. We ended up paying for the labor at 110. Is it more than the budget or less than the budget? That is it adverse or favorable? 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 It is going to be adverse because I've spent more than what? I've spent more than what I budgeted for. I spent more than what I budgeted for. So labor efficiency variance is equal to standard hours of actual production minus actual hours multiplied by the standard rate. Standard hours of actual production. The standard hours given there is 5 hours per unit of output. Is 5 hours. But then the actual production now, the actual production of the finished product TT, we are told is 1,400. We less actual hours, which we have there as 6,800. And 6,800, then I multiply by the standard rate, which I have somewhere here. The standard rate is 100 shillings. If that is done, I should be able to get my labor efficiency variance. My labor efficiency variance. So can we get it? 5,000 by 1,400. What are we going to have? 5,000 by 1,400. Tutakuwa na ngapi? 5,000 by 1,400. That is 7,000. So if you have your 7,000 here, you anticipated to do what? You anticipated to effectively use labor hours to, you anticipated to have this 7,000 hours. If you look at the actual output, you ended up spending 6,800. So is it favorable or adverse? Is it favorable or adverse? Of course, the difference here, the difference there is 200 by 100 will give us 20,000. So I want the sign. Is it favorable or adverse? Is it favorable or adverse? Is it favorable or adverse? It is favor. It is favorable. It is favorable. So that's what you are required to do there. That is what you are required to do there. It is a repetition of what we did yesterday. It is a repetition of what? It is a repetition of what we did yesterday. So we are now introducing 2 new items. We are now introducing 2 new items. We are now introducing 2 new items. That is overhead. That is overhead variances. So we have fixed overhead capacity variance, fixed overhead capacity variance, and fixed overhead efficiency variance. So that's what we need to add. That is what we need to add to these particular formulas that we covered yesterday. So before I proceed, are we now together up to that point? Are they making sense now that we are applying the same formula for the second time? Are they now making sense to someone here? Are they now making sense to someone in this meeting? Are they now making sense to someone in this meeting? Are they now making sense to anyone in this meeting? So now, if you want to deal with fixed overhead, the first one is fixed overhead capacity variance. We are going to have budgeted hours minus actual hours. Then I said, anytime you're going to deal with the overheads, the fixed overhead and the variable overhead, then now you bring in the concept of the last part of topic number 4, topic number 5, and topic number 7, which is the fixed overhead absorption rate multiplied by the fixed overhead absorption rate. So are we able to get the fixed overhead absorption rate? Are we able to get the fixed overhead absorption rate? That is what we need. That is what we need to put in place. So the next one that you are required to apply, after fixed overhead capacity variance, we are required to calculate the fixed overhead. That is the fixed overhead efficiency variance. Fixed overhead efficiency variance. Fixed overhead efficiency variance, which is equivalent to standard hours minus actual hours, then you multiply by fixed overhead absorption rate. So this overhead absorption rate is something that we are familiar with. So we need to get fixed overhead capacity variance. That is what we need to calculate. So the first item, we are required to get the budgeted hours. That is what you need to know. Then you also have fixed overhead absorption rate. So my interest is going to be fixed overhead absorption rate, which will be equivalent to budgeted overheads, and not just overheads, budgeted fixed overheads. Let me just make it clear. Budgeted fixed overhead divided by budgeted activity level. So the budgeted activity level here is now, the budgeted activity level there will depend on the rate that we have been given. What will be the absorption rate of the fixed overhead? Will it depend on the units of output? Will it depend on the total machine hours or total direct labor hours? What are we given? What are we given there? What are we given there? So as you can clearly see, our fixed overhead is given there. The fixed overhead is 5 hours at shillings per hour. That is 10 shillings per hour. So it means the fixed overhead is based on the hours. The fixed overhead is based on the hours. So are we able to get the fixed overhead absorption rate? The fixed overhead absorption rate, are we able to get it? Very simple. We don't even need to calculate anything. Just pick the figure and post it there. You don't need to calculate anything because it is now going to be over budgeted hours. Budgeted hours given there. So the budgeted units, our budgeted units, as per the budget, the fixed overhead is going to be incurred when you're doing production. So the fixed overheads, the monthly budget projects production and sales of 1,000 units. They are budgeting, or they are intending to do what? To produce 1,000 units, and the budgeted fixed overhead as per the unit is given there as how many shillings? 50 per unit. I just want us to make sense out of this. We are going to have our 50,000. That is the overhead. Then activity level. So budgeted hours. Budgeted hours tutakuwa na ngapi? Our budgeted hours is now hour per unit, which we have been able to see we have 5 hours per unit of tea, but then they are intending to produce how many units? To give us what? 5,000. Sasa watu wangu, if we follow our formula here, the fixed overhead absorption rate, tunakuwa na ngapi? The fixed overhead absorption rate, 50,000 divided by 5,000, which is going to give us 10. Are you able to see that 10 somewhere? Are you able to see that 10 somewhere? The budgeted fixed overhead absorption rate. The fixed overhead absorption rate. Are you able to see it somewhere? The fixed overhead absorption rate. The fixed overhead absorption rate. Are you able to see it somewhere? So that one, in this question, you don't calculate it. But if it is not given in a question, that's how we calculate it. The examiner will give you this. The examiner will give you budgeted hours here. The examiner will give you budgeted hours, and then you are given the 50 shillings per unit. And you know very well you have how many units? 1,000 as per the budget. So they are going to give you 5,000, and then you are going to be given things that help you to calculate the 50,000. And then you now have to arrive at this 10. In our question, for this sitting, you are not required to calculate. But even if you do it this way, still you're going to arrive at the same thing. You are going to arrive at the same thing. So that's what they want us to calculate. That's what they want us to do what? To calculate. So our fixed overhead, we've been able to see the fixed overhead absorption rate is equivalent to 10. Are we able to get budgeted hours? Budgeted hours, are we able to get it now? We've just calculated our budgeted hours here as 5,000. That's our budgeted hours. That is our budgeted hours. Even if the examiner did not mention it, but we are able to see it there by ourselves. We are able to calculate it. So our formula here, fixed overhead capacity variance is budgeted hours minus actual hours. Then we multiply by fixed overhead. We multiply by fixed overhead absorption rate. We multiply by fixed overhead absorption rate. So let's have it here. Let's have it here. The budgeted hours is going to be 5,000 with less actual hours. So are we able to get actual hours for the fixed overhead? Actual hours for the fixed overhead, we have 60,000 as shillings. And then the actual production ni ngapi? The actual production tumepewa hapo ni ngapi? Somebody to help us calculate that. Someone help us to calculate that. Let me do away with the 60 first of all. I want to see if people are really following what we are doing. What are we going to have? The budget, the actual hours. Actual hours tutakuwa na ngapi? Actual hours ni ngapi? Somebody to give us the actual hours. Actual hours ni ngapi? Yes, actual hours. 6,000, okay. 68,6. So if you look at what we have there in that question, the fixed overhead is now given as a full amount, as a block figure. What we now need to know is the actual hours that were given to us, and the actual hours that we have in the question, the actual hours does not change. The actual hours that we applied when we were calculating this, the actual hours will not change. They now multiply by our fixed overhead absorption rate of 10. We anticipated to have these budgeted hours for the fixed overhead of 5,000. We've ended up having 6,800. Is it adverse or favorable? The difference is going to be 1,800. So the difference is going to be 1,800, which is giving us 18,000. So is it adverse or favorable? Is it adverse or favorable? It is adverse. So that is fixed overhead capacity variance. Fixed overhead efficiency variance is equivalent to the standard hours minus actual hours, then you multiply by fixed overhead absorption rate. We already have our fixed overhead absorption rate. Whatever we are lacking now to replace this is the standard hours. Standard hours itakuwa nini? Standard hours tutakuwa na ngapi? Standard hours will be it is standard hours. It is standard hours in actual production. Standard hours in actual production. So basically what we are going to pick is this thing that you're having somewhere there. So the standard hours in actual production, we are supposed to have 5 hours. And there's something that somebody should not confuse. It is only that it is a coincidence that the direct labor hours, we add 5 hours per unit under the standard. The fixed overhead, we also have 5 hours per unit. We also have 5 hours per unit of finished productivity. So you should not confuse the two. The standard hours for labor is different with the standard hours for this. The reason why in this particular question, you are going to see them to be the same because all of them are having 5 hours. The standard hours is 5 in each of them. And we are going to multiply that by the actual production, which is 1400. So if you're going to deal with the labor, you take the standard hours of direct labor. If you're going to deal with fixed overhead, you take the standard hours of fixed overhead, which happens to be 5 in this question. So I believe you're not going to confuse the two. We are not going to confuse the two. So we have by actual production, we less actual hours, multiply by fixed overhead absorption rate. So this one is going to give us 7,000. It is more than this. So we've extremely saved on what we anticipated to spend. We've extremely saved. So it's going to be favorable. The only thing I'm now going to wait for from you is how much is the favorable amount? How much is it going to be really favorable? So what are we going to have there? What are we going to have? What are we going to have? What are we going to have there? What are we going to have? I don't expect it to be 18,000. This by this should give me 7,000. This by this should give me 7,000. Difference between 7,000 and 6,800 should be 200. Should be 200. Then I add this one here. So 2,000. So what I need from you is now the sign. Is it favorable or adverse? Favorable or adverse? Favorable or adverse? What are we going to have? What are we going to have? So that is it. That is what you are required to do in that particular question. The same things. If we now move to the next sitting, which is August 2022, we are also going to see the same thing. You are also going to see the same thing. But now to make you understand what we need to do, I would like us now to look at, if possible, multiple products, and there's this particular sitting. When you're going to deal with the multiple products, you're going to deal, multiple raw materials. So we have more than one. We have more than one raw material to deal with when you're going to calculate the variances. Let's say we have A, B, C. We have 1, 2, 3. How are we going to get now the material price variance? How are we going to get the labor rate variance? Very simple. Very simple. So for multiple raw material, multiple raw material, or where a company uses more than one raw material to do their production, then how are we going to get our material price variance? The material, actually this is what we normally have. This is what we normally have. Of course, it applies to the single product or one raw material. So for us to get material cost variance, how do we get the material cost? The amount you incur to buy raw material is equivalent to the units of the raw material multiplied by the selling price of each raw material. So it means for us to get the material cost variance, even whatever we just done, you are supposed to have the material price variance plus material usage variance. That is what you need to have. Material. So in a question, you are told to get material cost variance. Very simple. Get the price, get the material usage. Add the two. You'll be able to get your material cost variance. Then you now come down here and tell us material price variance. You have your raw materials there, of course, the multiple raw materials that you have. You are going to take the standard price minus actual price, then you multiply by the standard quantity. Multiply by actual quantity. That is what you need to have. So if I have 3 raw materials, I just get for each, I just create a column and do that. Good. If I have this, I want to get the material usage variance. So if I'm going to deal with now multiple products, what do I need to put in place now? It is selling price or standard price minus actual price, then I multiply by actual quantity. The actual quantity are now going to be, the quantities are going to be into 3. We are going to have standard usage in actual mix, standard usage in standard mix, and actual usage. So you're going to have this. You are going to have standard usage in actual mix. You are going to have standard usage in standard mix, and then actual usage in actual mix. These are the only 3 things we are adding. These are the only 3 things we are going to add to our formulas. We are going to add these 3, then you are done. We are going to add those 3, and then you are done. So where we have actual usage, actual quantity, we need to have our actual usage in actual mix. It is now what is replacing this. It is now what is replacing that actual usage in actual mix. That is what you are going to have. Somebody is wondering, what is this actual usage in actual mix? I have A, B, C. Proportion. So the proportion, you are going to have 10%, 60%. Of course, this will be 30%. So this is the proportion. I'm going to take 10% of raw material A, 60% of raw material B, 30% of raw material C to produce my finished product TT. That is what I'm going to do. This is now the standard we are setting, the standard. If I go now to actual usage, I'm not going to have this. I'm going to be able to see that I have. So let's say this is what we have. The 10% represent, let's say 5. This one here represent 15. This one represent 9. That's as per the standard. Actual, these percentages will not apply. I now look at the final product. What is the proportion of each? I have 4. I have 6. I have 8. Actual usage in actual mix will not be this proportion. It will now be the actual usage in actual mix, actual results. This is what I've actually achieved. Standard usage in actual mix, I'm going to come and get the total. Then I use the proportion that was given up here. The summation of this one here will be 18. So what proportion is product A taking? It is 10% of the total, 1.8. How about B? Taking 60% of this, which I think is 4.8. Then this other one taking 30% of this. 30% of this, which will be something 0.4. Which should be something 0.4. This one here will be 5.4. So if you look at what I have there, let's say we have that something of that kind. This one here, I'm going to call it actual standard usage in actual mix. The actual usage or the actual units is 18. But now if I look at the proportion, I'm taking now the ratio which was given up here. 10% of the actual, 60% of the actual, 30% of the actual. These percentages are the standard usage in actual mix. The actual quantity is 18. But if I use now the proportion as per the standard, this is what I have. So this is the standard usage in standard mix. Here, they anticipated that you are going to spend a total of 29. Yes, 29. So we have 29. It means for the 29, I'm going to look for 10% of 29 for A, 10% of 29 to give me 2.9. I'm going to look for 60% of 29 to give me a value. Then C, 30% of 29 to also give me a value here. I'm using, as per the standard, I'm using the proportions to distribute this. I'm using the proportion to distribute these standard values. The share that I'm going to get up here is what we call standard usage in standard mix. It is the standard usage in standard mix. Standard usage in standard mix. Standard usage in actual mix. Actual usage in actual mix. So if I'm going to compare the prices, it is actual usage in actual mix. What I've actually received in the process, or I've actually utilized to produce the finished product. Those are the only things you need to add or to understand. And then you are good to go. So let me say that is what you are going to have for the material price variance. For the material price variance, material usage variance is divided into two. We have material usage. So material usage variance, remember, we are now bringing the ratio, the proportion, the mix ratio that is now coming up here will now make us to split material usage into two. That is material mix variance and material volume variance. Yes, we are mixing them in this proportion, but if you now compare to the volume, the actual volume of the material, how are we going to mix these things? So we are going to be forced to divide this into two. Material usage variance will be material mix variance plus material volume variance. Material mix variance is equivalent to, material yield variance. Material yield variance. Yes, we've mixed them in this proportion, in this volume. But then what are they yielding? What are they giving us out as the outcome? Is it really in the proportion that we anticipated? I can use a lot of raw material to get a very small quantity of the finished product. So that's now where we compare the yield, usage. How are we mixing them and how are they giving us the output? Is it profitable? Is it productive? That's what we now need to look at when we deal with the material usage variance. We divide it into two. So after dividing it into two, we now need to get each. So material mix variance. We are mixing them. In what proportion? In what proportion are we now mixing the material? In what proportion are we now mixing our material? So the material mix variance will be actual usage in standard mix minus actual usage in actual mix. Now, remember I told you that the only place we are going to use the actual price is when you're going to compare the price. When you're going to look at the variance for the price. If you're going to look for the variance of the price, you'll have to apply actual price. Any other thing after that, we use standard price, not actual. Then we now have what we call material yield variance. What is it yielding? What is it giving out after doing the mixture? What is now going to yield? What will it give us as the final output? Is it productive? Is it favorable? Is it good? So that's where we are going to apply now the standard usage in standard mix minus standard usage in actual mix. Then we multiply by the standard price. That is what you need to put in place. That is what you need to put in place. So as far as this concept is concerned, this is what you need to do. This is what you need to do. That's all. You deal with the material, the multiple raw materials, the proportion that you're going to apply to utilize these raw materials. That is what you need. So this is the only additional thing you are going to add to the knowledge of what we've been covering there. So we should look for a question, though it has taken time since that concept was tested. Let me see. The very last part. The very last part of this question so that it qualifies for the cut. Just a small thing, then this question qualifies for the cut. The cut must be covering at least 60% of what we've been doing. But for our case, it should be 90% because we are only remaining with topic number 6. So even if it is 90%, it is not going to be bad. 90% of the management accounting course. I'm not able to see the question. So let me just give you a break of 5 minutes, a break of 5 minutes so that I get the question, then we do it together. A break of 5 minutes. Yes, I think I've been able to see it here. I have it already. That is question number 4. Question number 4A. Question number 4. Question number 4A. Question number 4A of which sitting? November 2018. November 2018, question number 4A. November 2018. The concept has not sunk well, but I hope in a question it will be understood. Yes. Yes, we want to do something about it. So November 2018, question number 4. Question number 4. Question number 4. Question number 4A. Question number 4A. Question number 4A. November 2018, question number 4A. So I think still your 5 minutes break is still valid. So you can just have a break of 5 minutes then we do it together. I think this one here will make sense before we touch on that. So we are being told that so that example, the way we have P, N, and Q. A fertilizer is made by mixing and processing 3 ingredients, that is P, N, and Q. The standard cost data are as follows. So if you compare this question with the other one, you'll be able to see those things that are relating. So we have ingredients or inputs, standard proportion, which we now have in percentage, what I was explaining here. Then we now have the standard cost, the standard price. Then a standard process loss is 5%. It is anticipated. Standard process loss is anticipated of 5%. In a period, the output was 93.1 tons and the inputs were as follows. So before even you calculate anything, we are being told that a standard process loss, so we have a process loss. We have a process loss of what percent? 5%. Now, this is my question. What does 93.1 tons represent? What percentage does this represent? A process loss is 5%. So the output we have here is 93.1 tons. Are we able to know the percentage that 93.1 tons represent? Are we able to see the percentage that 93.1% represents? So I want us to get this. Input should be 100%, is it? Process loss has taken 5%. The output is 95%. The important thing here is to get the input. So what was the input? What did they bring in for them to achieve the output of 93.1 tons? So if 93.1 tons is equal to 95%, are we able to get 100%? Are we able to get 100%? How many tons did we bring in? How many tons did we bring in to achieve that? How many tons did we bring in to achieve that? So 98 tons were brought in. So the standard input is 98. The standard input is 98, and they are going to share that 98 based on the proportions that are given there. The 50, the 40, and the 10 will be shared based on the proportion that we have there. This is what we need to calculate. This one here. If you compare it with the other question, you are able to see we also add a process. We also add a process loss. We also add a process loss. So let me just, if here will be enough, let me see. So the first question that they want us to calculate there is the standard costs are given, standard process loss. In the period, the output was this, and the inputs were as follows. Then, so that's the actual output given down there. So we are required to calculate the relevant variances using individual price method, weighted average price method. Now, my interest is very simple. Under individual price method, total direct material is variable and can be subdivided into the proportion that we divided here. So material cost variance is material price plus material usage. Material price is the formula. Material usage, it is now mix variance and yield variance. Mix variance is this, yield variance is this. So that is what we need to know. The first thing that we now need to get is the material price variance, which is the standard price. So I will come here and have my standard price. Then I have my actual price. Then I have the difference. Then I get my variance. So here I have the material. We have P, we have Q, we have N. The standard price of P. Sorry, there's something we are leaving. Actual usage in actual mix. So let's have actual usage here. Standard price, actual price, then actual usage in actual usage in actual mix. The standard price of P. Are we given the standard price of P? As per the standard. I want to see if somebody is following what we are doing. As per the standard, what is the standard price of P? As per the standard, what is the standard price of P? What is the standard price of P? First table, standard, we have ingredients or inputs, standard, proportion, then standard cost. So P, we are able to see we have 20. Then N, we have 25. Sorry, Q, we have 25. It is PN Q. So N, we have 25, and then Q, we have 42. That is the standard. If I move down, I'm able to see the actual. So the actual price is 16. For P, it's going to be 27 for N and 48 for Q. Actual usage in actual mix. Actual usage in actual mix. Actually, I can do and interchange these ones here. I deal with the difference first. Then I get actual usage in actual mix. The difference is this one here, the standard. So let's get back to what we were doing the other time. If my standard price is more than actual price, then automatically it is going to be adverse. Sorry, if this is the other way. So if this one is more than this, it is favorable. If this one here is less than this, it's going to be adverse. So I expected to spend 20. I've ended up spending only 16. So what am I going to have? It is a favorable. It's a favorable of 4. So it's going to be 4F. I intended to spend 25. I'm spending 27. It is adverse. I stated 42. I ended up doing 48. That is adverse of 6. Actual usage in actual mix. That's what I want now. Actual usage in actual mix. What are we going to have? Actual usage in actual mix. Actual usage in actual mix. So I want somebody to tell me for product P. Actual usage. Remember, that's now the quantity. How many tons did we use? Did we actually use? Now we go to the section of actual results. Actual results. What do we have for P? Actual results for P. Tuko na ngapi? Actual results for P. What do we have? Actual results for P is 49 tons. For N is 43 tons. For Q is 8 tons. So we already know we add a favorable. So 49 by this, this one here will give us 98. Then this one here, if you multiply by 4, will give us 196, if I'm not wrong. Or is it 186? Confirm. This one here will give me 84 adverse. This one here will give me 48 adverse. And of course, this one here is favorable. So confirm the figure up here. It is 196. It is 196. Favorable. So here we know very well that favorable is positive. 196 minus 84 minus 48. That is what we want. or that's what we are basically doing. So once you do that, material price variance is equivalent to the summation of these ones here. Tunakuwa na ngapi? Tunakuwa na ngapi? Tunakuwa na ngapi? Tunakuwa na ngapi? Somebody, the difference yote itakuwa ngapi? Difference yote tutakuwa na ngapi? The whole difference will be 62. So tell me whether it is adverse or favorable. Is positive more than the negatives? Is positive more than the? Should be 86. I'm not able to see the 43 you are referring to, unless I have a wrong figure. Actual usage should be 43 by this. Okay, this one should be 86. So I'm supposed to have 62, but then favorable. Favorable. That is part one, material price variance. This one here, as simple as such. Material usage variance. Material usage variance is equivalent to material mix variance plus material yield variance. Material mix variance. So let's go to material mix variance. Will be actual usage in standard mix. Then actual usage in actual mix. So we have now material. We have material. We have actual usage in standard mix, actual usage in standard mix. Then we have actual usage in actual mix. Then I'm going to have the difference. Then what do? I multiply by the standard price, and then I get my variance. So we have material P, N, Q. Actual usage in standard mix. Get the total, the actual. This is the actual usage in actual. Are we able to get the total number of units? This is what we need. The total number of units tutakuwa na ngapi? The total number of units. For us to get the actual usage in actual mix. Actual usage in actual mix. Total ni ngapi? Total. The total here is 100. Is it? If I add all this, I'm going to get 100. So that P, N, Q are supposed to share 100 in what proportion? In the ratio that is given in the question. So they're going to share that in the proportion of 50. So this one here will be 0.5 by 100, 0.4 by 100, 0.10 or 10%, 0.1 by 150, 40, 10. So that is now the actual usage in standard mix. Actual usage. So we have our actual usage, which is 50 in the standard mix. In the standard mix. Then I take actual usage in actual mix, which is already up here. I budgeted for 50. I've actually used 49. That is good. So it is favorable. I plan to spend 40. I'm having 43. That is unfavorable. That is adverse. I planned for 10. I ended up using 8. That is favorable. Standard price. We have it up here. You copy and paste. You copy and paste. Variances now. 1 times 20 will be 20F. 3 by this will be 75A. 2 by 4 will be 84F. Let us get the variance. Material mix 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 variance tunapata ngapi? Material mix variance tunapata ngapi? Material mix variance. Na tujue hii ni A, adverse. So these are all negative. Negative 75 to 84. That's going to be around 10. If I add to 20, it should be 29 favorable. 29. So the very last one that we need not to forget. So if you look at this, if you look at what I have here, this one here should add up to 100. And this one also is going to be the same. They are going to be the same. They are going to be the same. So the only thing now we are going to look for is the material yield variance. Material yield variance says it is standard usage in standard mix. So I come here and have my material. Then I have standard usage in standard mix. Then standard usage in actual mix. I look for the difference, standard price, and then variance. Material, we have P, N, Q. Standard usage in standard mix. Remember we calculated here and got that for us to get an output of 93.1 tons, we were having 95% after losing the 5%. The 100% now was giving us 98 tons. So this 98 tons, we divide it using the standard ratio. So what will be P having? P will be taking 0.5 multiplied by 98, 0.4 by 98, 0.1 by 98, which I know this one here will give me 9.8. So give me this figure, 0.5 by 98. Then standard usage, usage in actual mix. We have it somewhere here. Standard usage, it should be actual usage in standard mix. It should be actual usage in standard mix. So actual usage in standard mix. Actual usage in standard mix, we have it somewhere. This one here, 50, 40, 10. Hapa sasa nangoja. I'm told P is 49. And this one here, hii ni ngapi? N is 39. 39.2. So get the difference, then you take the standard price, 20, 25, 42. Then you get the variance. Sasa nataka watu wafanye hiyo very fast, so that we get material yield variance. Get material yield variance. What are we going to have? What are we going to have? So you calculate this, get the variance column, Once that is complete, when we now meet on Thursday, we are going to do the one in the past paper. So do it, and then we revise that and move straight away to topic number. 6. Thanks for your time. Have a blessed night, and let's meet on